The holy grail of digital finance, a yield-bearing dollar you can spend anywhere. Introduction. Money is evolving. Again, for decades, the US dollar has served as the world's dominant currency. Not because it's the most innovative, but because it has been the most trusted. But trust is no longer enough. In a world of instant global settlement, real-time finance, and programmable everything, users, whether individuals, institutions, or developers, now demand more: yield, liquidity, composability, and ubiquity. The modern user doesn't just want to hold dollars. They want dollars that work. Dollars that earn yield while idle. Dollars that can be spent anywhere. Dollars that move at the speed of the internet but are backed by the safety of real collateral. In short, they want the holy grail of digital finance, a yield-bearing dollar that you can spend anywhere. The search for this ideal form of money is already underway. It's a competitive race among regulated institutions, blockchain-native protocols, and legacy financial giants, all vying to issue the dollar that defines the next chapter of global commerce. 2. The 4 dimensions of the perfect digital dollar. Before we examine the contenders, we must first define the attributes of the prize they seek. 1. Yield-bearing capability. The dollar must provide return. With U.S. Treasuries yielding over 5%, users can no longer ignore opportunity cost. Any idle dollar that fails to earn is a depreciating asset in real terms. Yield is not a luxury, it's now a user expectation. Spendability and liquidity. Holding yield is meaningless if it comes with friction. The perfect digital dollar must be instantly liquid, spendable on day-to-day expenses, and usable in both online and offline commerce, preferably through seamless integration with existing cards or mobile apps. 3. Borderless utility. A truly digital dollar should move without regard for borders, bank hours, or correspondent networks. Whether you're in New York, Nairobi, or Manila, it should work anywhere value flows. 4. Composability and regulatory alignment. Composability means that the dollar can plug into DeFi, fintech, payroll APIs, and payment rails without bespoke integrations. Regulatory alignment ensures its use is compliant and durable, especially in jurisdictions like the US, where regulatory clarity is paramount. Together, these 4 dimensions form the template against which all contenders must be measured. Here's Section 3, Comparative Landscape, Current Contenders. The race for the ideal digital dollar isn't theoretical. It's already underway. Let's examine the key contenders and how they align or fall short across the 4 critical dimensions: yield, spendability, borderless utility, and composability. USDC, the compliant internet dollar. Issuer, Circle with Coinbase backing. Regulatory status, regulated under state money transmitter laws and indirectly aligned with the CFTC via upcoming derivatives collateral use. Highly trusted, fully backed, compliant, widely used in DeFi. Weaknesses: offers no native yield, distribution bottleneck through Coinbase, limited real-world spendability. Fit summary: yield, no; spendability, limited, currently only via back-end pilots like Visa. Borderless, yes. Composable, yes. USDC is the current plumbing layer of crypto dollar commerce, but without native yield or front-end payment integration, it's a bridge, not the destination. USDT, the diaspora dollar. Issuer, Tether, unregulated offshore. Regulatory status, minimal U.S. oversight, based in the British Virgin Islands. Strengths: most liquid stablecoin globally, strong presence in emerging markets. Weaknesses: no yield, opaque reserves, not suitable for regulated environments. Fit summary: yield, no; spendability, yes, especially for peer-to-peer use. Borderless, yes; composable, yes. USDT dominates in regions where trust in local currencies is low and where censorship resistance outweighs regulatory compliance. BUIDL, the institutional yield dollar. Issuer BlackRock, tokenized via Securitize. Regulatory status: SEC-compliant tokenized money market fund. Strengths: backed by U.S. Treasuries, offers real yield, accepted as collateral on exchanges. Weaknesses: not yet spendable in retail contexts. Access may still be gated by KYC AML policies. Fit summary: yield, yes; spendability, no, but could be unlocked via integration with payment networks. Borderless, limited, depends on regulatory access. Composable, yes. BUIDL may be the strongest U.S.-aligned contender, but its true power unlocks only when it becomes spendable via cards or wallets. Fidelity MMF, the TradFi benchmark. Issuer, Fidelity. Regulatory status, SEC-registered money market fund. Strengths, earns yield, linked to a debit card for instant spending, already trusted by millions. Weaknesses, not blockchain-based, limited to U.S. customers, no composability or programmable features. Fit summary, yield yes, spendability yes, borderless no, composable no. This is the gold standard of TradFi's attempt at the Holy Grail, but its closed architecture and national limits prevent global scale. Ethena Frax, the synthetic yield dollars. Issuers, protocols like Ethena Labs, Frax Finance. Regulatory status, unregulated, high-risk DeFi instruments. Strengths, provide synthetic yield, designed for DeFi native composability. Weaknesses, fragile peg mechanisms, exposed to smart contract and derivatives risk, lack legal clarity. Fit summary, yield yes, spendability no, borderless yes, composable yes. These are innovation sandboxes, useful for experimentation, but unlikely to serve as global settlement currencies without significant maturation. JPM Coin, the wholesale interbank dollar. Issuer, JP Morgan, via Onyx. Regulatory status, fully bank regulated and approved. Strengths, used for real interbank settlement, extremely fast and efficient within JPM's network. Weaknesses, closed loop, unavailable to public or outside institutions. Fit summary, no. Spendability, limited, only for JP Morgan's institutional clients. Borderless, no. Composable, no. JPM Coin may never go public, but if it ever did, it could become the Fed's de facto proxy for a wholesale stablecoin standard. IV, domestic versus global use cases. The perfect digital dollar is not one size fits all. Its real-world adoption depends heavily on who is using it, where they are using it, and why they value it. From small business owners in Nigeria to savers in Nebraska, the priorities diverge, but together they shape the future of dollar-based digital finance. Domestic U.S. use cases, yield, compliance, and spending utility. Within the United States, users tend to prioritize. Regulatory clarity. U.S. consumers and institutions demand products that won't be rugged by regulators. Trust matters more than anonymity. Yield opportunities. With interest rates elevated, many Americans are actively seeking yield-bearing alternatives to bank savings accounts. This is where products like BUIDL or Fidelity MMF shine. Seamless spending. The ideal product merges spending with yield, allowing dollars to earn while idle and be instantly liquid when used via card or app. Key insight. The average U.S. user doesn't want a new currency, they want a better dollar. One that earns, works everywhere, and integrates with existing financial habits. This is why Visa or MasterCard integration with a token like BUIDL would be game-changing. It would merge TradFi familiarity with DeFi infrastructure. Global use cases, liquidity, accessibility, and censorship resistance. Outside the United States, particularly in developing economies and among the diaspora, the priorities shift. Liquidity over compliance. Users abroad need dollars that work, now, regardless of whether they are fully regulated or not. Access over yield. Many global users simply want stable purchasing power in USD terms, not necessarily yield-maximized products. Censorship resistance. In regions with capital controls or authoritarian regimes, the ability to move and store money without permission is critical. This is why Tether USDT dominates global usage. Despite offering no yield and being less transparent than USDC, it provides frictionless onboarding, deep liquidity, familiarity through P2P and mobile-based ecosystems. Key insight. The diaspora doesn't wait for regulation. They go where the liquidity lives. And in these regions, Visa and MasterCard are not kingmakers. Adoption flows through informal channels, WhatsApp, Telegram groups, local crypto vendors. Converging threads. These user needs aren't mutually exclusive. They are converging. The endgame is a product that offers yield like BUIDL, has liquidity like Tether, is spendable like Fidelity MMFs, is composable like USDC, is globally available and regulatory aligned like a public-private hybrid. That convergence is the Holy Grail, a spendable, yield-bearing dollar that works everywhere, for everyone. Section 5, Future Pathways and Catalysts. If the current contenders are racing toward the same finish line, the real question becomes, what developments, technical, regulatory, or market-driven, will determine who gets there first? This section explores the catalysts that could accelerate or block the path toward a fully realized, spendable, yield-bearing digital dollar. 1. Integration with payment networks, Visa, MasterCard, Apple Pay. The clearest path to mass adoption lies in bridging yield-bearing tokens with real-world payment systems. Imagine a BlackRock BUIDL token earning over 5% yield, instantly spendable at checkout via a Visa or MasterCard debit card, backed by short-term U.S. Treasuries and usable anywhere in the world. This would be a Fidelity MMF card on steroids, only this time built on public or semi-permissioned blockchain rails. Why it matters. Unlocks massive utility for U.S. users who want yield and liquidity. Could onboard users passively. They don't need to care about the back-end tech. Converts stablecoins from savings tools into active money. 2. DeFi collateralization and lending markets. The next step for tokens like BUIDL is to become borrowable against in both DeFi and TradFi, used as collateral, not just as store of value. This unlocks capital efficiency, margin trading, institutional use in structured finance products. Already happening, Deribit and Crypto.com accept BUIDL as collateral. More protocols, like MakerDAO or Frax, could wrap BUIDL for DeFi composability. Watch for protocol wrappers, EGST BUIDL. See BUIDL, lending platforms integrating tokenized MMFs, DeFi native rebase layers that track MMF yield in wrapped form. 3. Adoption for payroll, rent, and taxation. If digital dollars can be paid to employees, accepted by landlords, used to pay federal, state, local taxes, then they've moved from asset class to true currency. What would enable this? APIs to integrate BUIDL or USDC into payroll software, e.g. Gusto, ADP, merchant incentives to accept stablecoins over expensive fiat rails, government programs recognizing stablecoins for remittances or tax collection. Why it matters. Real-world utility locks in user behavior, creates a flywheel, earn in it, save in it, spend in it, pay taxes in it. 4. Regulatory greenlights or guardrails. The regulatory landscape remains the wild card. Right now, USDC is safe but yieldless. BUIDL is compliant but limited in spendability. Synthetic stablecoins like Ethena offer yield but face existential risk from future crackdowns. What could change the game? Legislation allowing yield-bearing stablecoins to be offered to retail. Clear custody frameworks for tokenized MMFs. Unified federal charter for stablecoin issuers instead of patchwork state laws. Constraints to watch. The Genius Act or similar may include carve-outs that prevent yield sharing with retail. Banks lobbying to preserve their deposit base by delaying fintech entrants. CFPB policy on what constitutes money transmission versus investment. 5. Consolidation of banking and fintech rails. U.S. banks are structurally weak. They hold long-duration bonds at a loss post-ZIRP. They rely on programs like BTFP to avoid insolvency. They can't offer competitive yield without bleeding themselves. Meanwhile, fintechs can build leaner platforms, tokenize T-bills, offer composability and automation. Key risk, regulators may protect the banks by restricting stablecoin issuers from offering yield, a form of policy gatekeeping. Key opportunity, fintechs, asset managers, or even crypto-native firms leapfrog banks entirely if granted access to Federal Reserve or Treasury securities pipelines. 6. Interbank tokenization plays, JPM Coin, Citi Token, etc. If JP Morgan opens its rails to other banks or pushes for public regulatory approval of JPM Coin, it could create a TradFi stablecoin cartel. Think, a dollar backed by JP Morgan, Citi, and BNY Mellon, settled instantly via Onyx or similar, fully integrated into the existing correspondent banking ecosystem. Threats posed. Could choke out public stablecoins via regulatory capture. Would likely favor institutional and cross-border settlement use cases, not retail payments. Upside. If public-private hybrid models emerge, these banks could still plug into programmable, composable ecosystems under strict guardrails. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 6 risks, constraints, and power plays. As the race to build the ideal digital dollar accelerates, so do the structural tensions behind the scenes. What looks like a straightforward product innovation, spendable dollars that earn yield, is in reality a battlefield shaped by regulatory bottlenecks, institutional self-preservation, and geopolitical undercurrents. This section breaks down the key frictions that will shape or stall the outcome. 1. Banking sector resistance and deposit fragility. Traditional banks are losing deposits to money market funds and treasuries. They, locked in low-yield, long-duration bonds during ZIRP, were caught flat-footed by the Fed's rate hikes, are now facing unrealized losses and balance sheet pressure. To survive, they depend on programs like the Bank Term Funding Program, BTFP, limiting competition from yield-bearing digital dollars. Why this matters? Banks have enormous regulatory influence. Many are pushing for restrictions that would prevent fintechs and stablecoin issuers from passing through yield. Example, the Genius Act carve-out reportedly restricts stablecoin issuers from sharing yield with retail customers, a defensive move to preserve the banking moat. Implication, banks can't compete on yield, so they will attempt to regulate away competition. 2. Policy moats, who gets to issue yield-bearing dollars? The key question regulators must answer is, should private institutions be allowed to offer a digital dollar that earns yield, is liquid, and competes directly with bank deposits? If yes, BlackRock, Fidelity, and Circle could become de facto central banks of the internet economy. Tokenized money market funds might become primary money for savings and transactions. If no, we may see continued restrictions on public stablecoins and DeFi native dollar products. Policy will favor closed-loop TradFi solutions, e.g. JPM Coin, or non-yielding stablecoins like USDC. This is the core political tension, monetary innovation versus institutional control. DeFi native fragility, peg risk, and smart contract failure. Protocols like Ethena, Frax, or USD aim to create synthetic, yield-bearing dollar alternatives, but they face existential risks. Peg fragility. These tokens often rely on complex derivative strategies, e.g. delta-neutral ETH perps. Black swan exposure, smart contract exploits, or market volatility can break the system. Regulatory gray zones. These products may be deemed unregistered securities or investment contracts. Example, Athena's USD ballooned to over $5 billion in market cap in months, but remains fragile due to over-reliance on centralized exchanges and funding rates. Implication, while innovative, these models may never reach retail or institutional scale without major de-risking. 4. Composability versus control. The more composable a digital dollar is, meaning the more platforms, chains, and apps it can interact with, the more powerful it becomes. But this open design comes with trade-offs. Open tokens like USDC and USDT are powerful but hard to control. Closed systems, like JPM Coin or Fidelity MMFs, are controllable but limited in scope. The fundamental tension: do regulators and incumbents prefer programmable money that anyone can build on, or controlled assets inside walled gardens? This is where developers and institutions will diverge. Developers want open APIs, multi-chain functionality, and liquidity pooling. Institutions want compliance, KYC, custody rails, and guardrails. 5. Geopolitical and strategic implications. Beyond finance, the winner of the digital dollar race becomes a strategic asset to the U.S. economy. The U.S. will not issue a retail CBDC, but it may bless private stablecoin frameworks that become global standards. China's ECNY is live and integrated with trade settlement systems. Tether USD already functions as a gray market dollar in many parts of the world. If the U.S. wants to maintain global dollar dominance in a multipolar currency world, it needs to back a globally useful, compliant, yield-bearing dollar, ensure it scales through fintechs, not just banks. Avoid letting JP Morgan or foreign actors define the next standard in its absence. Section 7, Convergence. What happens when saving equals spending? We're approaching a moment where two previously separate functions of money, saving and spending, are on track to converge into a single programmable asset. This is not just a technical evolution. It is a paradigm shift in how value is stored, accessed, and mobilized. The old world forced a choice. Want yield? Lock your dollars in a savings account or a bond fund. Want liquidity? Keep cash in your checking account or wallet and forfeit yield. The new world asks, why not both? 1. The fracture is already fading. Products like Fidelity's MMF with debit card, BlackRock's BUIDL token, Tokenized T-bill vaults on DeFi, e.g. Ondo, Maple, Superstate, are already demonstrating that it's technically feasible to earn yield and maintain liquidity. But none of them yet offer the trifecta: yield, instant spendability, global composability. 2. The new monetary standard is programmable. Once a dollar can earn yield automatically via smart contracts or asset exposure, be spent at any merchant without friction, be used as collateral in DeFi or TradFi lending, move globally instantly 24/7, it no longer behaves like money as we know it. It behaves more like an operating system for value, simultaneously functioning as savings because it earns, checking because it's liquid, capital because it can be deployed, currency because it's spendable. User experience as the ultimate convergence point. What will the user see? Ideally, nothing. A frictionless interface where you receive payment in a token like BUIDL. It immediately starts earning yield. You swipe your card at Starbucks, and it automatically converts the necessary amount into spendable fiat or blockchain rails. You never think about transferring funds between checking, savings, or investment accounts again. This is the future. Money that works while you sleep and spends when you need it. 4. Whoever builds that rail owns the next standard. This is the real prize. It's not just about replacing cash. It's about redefining monetary architecture, winning long-term user mindshare, becoming the default container for global value storage and movement. Who's in the best position? BlackRock, via BUIDL, has the assets and institutional trust. Fidelity has the retail user flow and existing yield spend UX. Circle has the crypto-native distribution and composability. Tether has the informal economy and diaspora lock-in. JP Morgan has the institutional rails and regulatory capture, but none of them yet have combined all dimensions into a single product. Strategic implications of convergence. If saving and spending converge, many existing systems break. Retail banks lose their business model. Credit cards become redundant as programmable wallets take over. Central banks lose control unless they integrate or regulate effectively. Developers and users gain leverage in defining how financial systems evolve. It will no longer be about custody. It will be about composability, programmability, and permissionless utility. The real holy grail isn't just a better dollar. It's the collapse of monetary silos. And whoever collapses those walls first will own the rails of 21st century finance. Final section, 8. Conclusion. The search for the perfect digital dollar is not a thought experiment. It is a live competition, a convergence of finance, technology, regulation, and strategy. What's at stake is not simply who mints the next popular stablecoin, but who defines the next monetary standard for the digital age. The Holy Grail is taking shape. A yield-bearing, spendable, composable, and globally available dollar. Earns yield like a money market fund. Spends instantly like cash or a debit card. Moves freely across borders like email or data packets. Plugs into apps and protocols like a native API for value. Each major contender, USDC, BUIDL, USDT, Fidelity, JPM Coin, Ethena, represents a partial realization of this vision. Yet none have delivered the full package. Not yet. We are witnessing monetary Darwinism. What we're seeing is a kind of monetary natural selection. USDC optimizes for trust and regulatory compliance. UST wins through ubiquity and raw utility in emerging markets. BUIDL represents a compliant institutional bridge to yield. Fidelity quietly serves as a benchmark for integrating yield and spendability. Ethena and Frax push the boundaries of yield and composability from a DeFi angle. JPM Coin builds fortress-like infrastructure for interbank liquidity. Each has evolved under different pressures, but only one, or a hybrid, will define the next dominant form of the US dollar. The real battle is for the user's default behavior. The winner won't be the protocol with the flashiest marketing or the biggest market cap. It will be the one that users default to without thinking. The one that makes saving and spending indistinguishable, feels like a bank account, wallet, and investment portfolio in one, is trusted, seamless, and composable from the ground up. And once users adopt it, they won't go back. Final reflection, the convergence of yield and liquidity is not just a feature upgrade. It is a systemic redefinition of money. And the rail that supports this redefinition will absorb billions in global savings, reshape capital markets, redefine the balance of power between banks, fintechs, and protocols, potentially become the reserve layer of the internet economy. Whoever builds that rail doesn't just win the market. They become the new infrastructure of global economic coordination.